Okay, hi everyone. Welcome to my new video on Introduction to Investments Part 2. So this video is going to be a bit long. So what I'm going to do is that I'll break Part 2 into Part A, and then in another video it will be Part 2B, and that will complete all of the Introduction to Investments. Right. Hi, once again, I'm Will Chia, and you're watching this video on my YouTube channel. Thank you for watching. So this video is very relevant to students who need to have a quick revision, a quick review of what are the different types of securities that can be traded. Right. So let's look at the scope. Right. Understand the general characteristics of the different types of securities, and then next is to understand and explain how a business may make investment decisions in light of the characteristics of the different securities. Now, in the investment world, there are various securities, and each security, because it's so different, that it'll be suitable to businesses with their unique kind of investment criteria. And then it's also because securities are so different in terms of liquidity, maturity, risk, and return, which is why it is quite difficult for all businesses to invest in the same security and hope that will achieve their whatever strategic goals, right? So depending on what surplus that the business has, as I mentioned before, businesses may have temporary or permanent surpluses, and that actually influences their investment time frame, right? Of course, another thing is that what's the risk appetite of businesses, and whether they are whether they have an aggressive treasury policy to want to invest actively in securities. So these characteristics of each security would also influence how businesses make their decision on investments. Alright. Now, so let me introduce to you. So basically, in this video, which is part 2A, we'll be covering some of the items, and then what we may do is that we're going to try to cover the rest in part 2B. Alright. So we'll be looking at equity, corporate bond, government bond, warrants, commercial paper, and certificate of deposit, bill of exchange, and finally local authority stock. Right. So there are others, but given the fact that I'm doing an introduction to investments, I won't be going into too much detail on the exotic instruments. But if you're interested, we can talk about it outside of the video. Okay. So investments can also be broken down into where they are traded at. Typically, investments may be traded in capital markets. Now, capital markets would be mainly where the investment time frame is longer term, right? Businesses with excess funds would go to capital markets and invest long term. Businesses that require funds for the long term would also try to have access to all these funds on capital markets, right? So whether it's the need to invest long term or whether it's the need to obtain funding long term, businesses would turn to capital market, right? And capital market is where equity instruments are traded, and so are bonds, right? Now, money market is quite different from capital markets, right? Money market is more for businesses that wish to invest short term, or maybe, if not, to borrow short term, right? The typical instruments that get traded in money markets would be things such as the certificate of deposit, right, which we'll be discussing about it in this series of videos. And there is also, just now I mentioned, the bill of exchange, right, and there is also the commercial paper, right, and then there is also the local authority stock. So there is quite a number of different types of security right? Makes it quite hard to cover all of them. So let's start with equity instruments. Now, equity instruments or equity investments basically confer ownership in the company, and that ownership is in the form of shares, right? And how could one take share ownership, right? How could one have an ownership in the company? So if you are interested to have an ownership in the company, what you can do is that you can start to acquire shares of the company, and by acquiring the shares of the company, you are said to be investing in equity. So if you are interested to invest in shares of a company, let's say a listed company, it's fairly simple. What you can do is that you can apply for shares that are offered, in what you call an initial public offering. So all you have to do is just apply for the shares of the company through the IPO, and then if you're successful, you get to have share ownership in the company, right? Now, this share ownership in a company also gives the holders of these shares voting rights, right? So there are some benefits to equity investments. Other ways that one can invest in equity is rights issue. Now, rights issue is where the company issues additional shares to existing shareholders, right? Now, this can happen to any company. So if a company requires more funding from shareholders, they may have rights issue, right? Bonus issue. Bonus issue is where a company, instead of issuing dividends, the company issues shares, right, in place of dividends. So shareholders receive shares instead of dividends. So that's bonus issue. Bonus issue is funded through reserves of a company, right? So certain companies have rich reserves, large amounts of reserves, and these could be used to issue bonus shares. Now, a company can further offer investors an opportunity to invest in equity by offering what we call a placement. A placement is quite interesting. Basically, placement means that a company directly offer its shares to potential investors, right? A placement basically assures the company that there is a good issue price, and then there is a very good chance of 100% take up of all the shares offered under the placement, right? But whichever it is, right, equity investment can take the following forms, right? It may take some other form as well. Equity investments provide returns, especially in the form of capital appreciation. So in some cases, if you are investing in the stocks of a listed company, then the prices of the shares of the company may appreciate over time. Now, if you hold the stock or the share, right, dividend returns are also possible depending on the company's profitability, right, and also the company's dividend policy, right? So not all companies will have the same dividend payout rate. So it all depends on profitability and also the dividend policy, right, which varies quite a lot depending on the company and the management. Equity investments are typically traded in money markets. So if you wish to invest in equity, then you could go through the capital markets. Now, aside from investing in equity, you could choose to invest in debt. Some may refer to this as fixed income, right? Fixed income instruments. So debt instruments are quite straightforward. Basically, debt instruments may be including bonds issued by governments and corporates, right? So such investments are attractive in a way because it guarantees maybe, right, interest return, and this rate of interest return may be either fixed or floating, right? And Also, there is potential for capital appreciation depending on the demand for bonds. Maturity of the bonds may vary depending on the terms of the issue, right? So you might have a bond that matures in 2 years, 5 years, 10, 20, or may never mature. There is some the extent of default risk, reason being that a debt instrument essentially still is a form of a loan to a entity. So there is always some risk that the principal may not be, recoverable. There is some risk that interest that is due, or we say the coupon that is due, may not be payable. So some extent of default risk is surely present. Okay, there are different types of debt investments, one of which is debentures issued by corporates, right? Very common, right? And then you also have bonds issued by governments, also very common, right? Now, so next item. Let's look at more details on government bonds. Government bonds can be further classified into shorts, mediums, longs, and perpetuals. Shorts referring to those bonds that mature within 5 years, right? I'm referring to UK bonds. Now, mediums will be those bonds that mature between 5 to 15 years, and longs will be those that mature beyond 15 years, and perpetuals is forever. Or rather, you could say it depends on when government decide to redeem these bonds. So perpetuals do go much longer than longs. So in the UK, government bonds are typically known as gilts, right? Such government bonds usually have very low default risk, and I think you can understand why, because seldom do you see governments going bankrupt. It's more likely to see a corporate becoming bankrupt than, or seeing a corporate becoming insolvent than a whole government turning bankrupt. Right? Governments don't really, turn insolvent or bankrupt unless there is some adverse or very serious economic crisis. Then governments may collapse, but it's not very likely. For the case of gilts, the interesting fact about it is that there is a secondary market for them. Now, you remember from the previous video I mentioned to you that secondary market is very important because it ensures that investments enjoy, you can remember the word, liquidity. It makes it possible for investors to be able to buy and sell these securities, right? Another feature of gilts is that the coupons, or if you prefer the other word, the interest is payable half yearly until maturity, right? So that's government bonds. Corporate bonds are a bit more interesting, right? These are issued by corporates. Default risk is of course higher because corporate failures are more common than bankrupt governments, right? So depending, corporate bonds may be secured depending on the length of maturity and also the principal, right? The size of the principal. Some examples of corporate bonds include straight bonds. Straight bonds basically are those that pay coupons regularly, right? That's what it means, right? So coupons are payable regularly until the time when it matures. Now, deep discount bonds simply means that the upfront price is heavily discounted. Now, why is it that there is a deep discount bond? The reason is that with a very cheap issue price, or an issue price that is heavily discounted, it attracts investors. Right, so that is what we term by deep discount bonds. Basically, it means the issue price is heavily discounted. Right. Let's say, for example, if it was supposed to be $100, but then the deep discount might be something like resulting in maybe say an issue price of 40 or 30 even. A zero coupon bond is quite different from deep discount. Simply, it means no coupons payable. Now, for such zero coupon bonds, usually to attract investors, these zero coupon bonds also tend to be heavily discounted, right? Convertibles are quite interesting. These are also bonds, but these bonds basically offer an option to convert to equity. So it's quite attractive because it gives you that flexibility, or it gives the investors, the holders of convertibles, the flexibility to convert. So as a result, investors of convertibles enjoy both upsides and of course more upsides, and yet at the same time avoid downside risk. So like for instance, if the investors of convertibles realize that the value of the company's equity may be declining, then such investors may not want to convert the equity, and instead what they may want to do is hold on to the convertible bond, right, until it matures. Another interesting characteristic of convertible bonds is that the rate of coupon is much lower than normal bonds, right, than other types of bonds, right. So there are quite a number of varieties. Okay, next. Okay, so let us cover the last portion, then we are going to continue with the rest in part 2b. So finally, just to conclude, bond investments also face, aside from default risk, interest rate risk. Interest rate risk has a profound impact on the price of bonds, right? And what else? Exchange rate risk is also present if, let's say, these bonds are denominated in foreign currency. The final point is that bonds are typically traded in capital markets. So we will continue with part 2b in another separate video. Okay, thank you for watching. I'm Will Teacher, and you've been watching this video on my YouTube channel. Thank you.